At its core, a fund is just a pool of money. Instead of you buying 20 different stocks one at a time, a fund collects money from thousands of investors, combines it, and buys a basket of investments on everyone's behalf. You own a slice of the basket. That's it. That's the whole concept underneath every term we're about to cover. The differences between index funds, mutual funds, hedge funds, and ETFs come down to 4 questions. Who decides what's inside the basket? How do you buy and sell your slice? Who's allowed to invest? What does it cost you? Keep those 4 questions in mind. Every distinction in this video maps back to one of them. Let's start with mutual funds, because they're the oldest and most familiar structure. Your parents probably have one in a retirement account right now. What it is, a mutual fund pools money from many investors, and a professional manager, or a team, decides what to buy and sell. Some mutual funds try to beat the market by picking stocks they believe are undervalued. These are called actively managed funds. Others simply track an index, which blurs the line with index funds. More on that in a second. How you buy it: you don't buy mutual fund shares on a stock exchange during the day. Instead, you place an order, and at the end of the trading day, the fund calculates something called the net asset value, or NAV, basically the total value of everything in the basket, divided by the number of shares. You get shares at that one price, calculated once per day, after the market closes. The cost: this is where mutual funds get a reputation problem. Actively managed mutual funds often charge what's called an expense ratio, an annual fee, usually somewhere between 0.5% and 1.5% of your investment, sometimes more. Some also charge load fees, a sales charge just for buying or selling, which can run another 3 to 5%. Here's the uncomfortable statistic: decades of research, including studies from S&P Dow Jones Indices SPIVA reports, consistently show that the majority of actively managed mutual funds underperform their benchmark index over long periods, often 80% or more over a 10 to 15-year horizon. You're paying a premium for a manager to try to beat the market, and more often than not, they don't. Who it's for: mutual funds still make sense for some people, particularly inside employer retirement plans where index options might be limited, or for investors who want exposure to a strategy that genuinely requires active judgment, like distressed debt or niche international markets. But for a core, long-term portfolio, the fee drag is hard to justify for most people. Now let's talk about index funds, and this is where the story gets a lot more investor-friendly. What it is: an index fund isn't trying to beat the market. It's trying to be the market, or at least a specific slice of it. If it tracks the S&P 500, it simply buys all 500 companies in that index, in roughly the same proportions. No guessing, no stock picking, no manager trying to outsmart anyone. The philosophy: this idea was popularized by Jack Bogle, founder of Vanguard, who argued that since most active managers fail to beat the market after fees, investors are better off owning the whole market for a fraction of the cost. That single insight reshaped the entire investing industry. The cost: because there's no team of analysts trying to pick winners, the fund just mirrors an index, the expense ratios are dramatically lower. Many S&P 500 index funds charge 0.03% to 0.10% per year. Compare that to a 1% actively managed fund, and over 30 years, that fee difference can cost you tens, even hundreds of thousands of dollars in lost compounding. How you buy it: here's the nuance: index funds can be structured either as mutual funds, bought once a day at NAV, or as ETFs, which we're about to cover, and which trade throughout the day. Index fund describes the strategy. Mutual fund and ETF describe the structure. They're not always mutually exclusive categories, they actually overlap. Who it's for: for most long-term investors building wealth for retirement, low-cost index funds are widely considered, by financial educators, by Bogle himself, and even by famous active investors like Warren Buffett, one of the most reliable tools available. Buffett has repeatedly recommended low-cost S&P 500 index funds for the average investor, and even bet $1 million on it outperforming a basket of hedge funds. He won that bet. Now, ETFs. This is the structure, not the strategy, and it's important not to confuse the two. What it is, an ETF, or exchange-traded fund, is a basket of investments, just like a mutual fund, but it trades on a stock exchange throughout the day, just like an individual stock. You can buy or sell at any time the market is open, at a price that fluctuates minute to minute. How it's different from a mutual fund: 3 big differences. Trading flexibility: mutual funds settle once a day. ETFs trade continuously, so you can react to price moves in real time, place limit orders, or even short them. Minimum investment: many mutual funds require a minimum investment, sometimes $1,000, $3,000, or more. ETFs let you buy a single share, sometimes even fractional shares through certain brokers. Tax efficiency: ETFs are generally structured in a way that creates fewer taxable events for the average holder, because of how shares are created and redeemed behind the scenes, a mechanism called the in-kind creation/redemption process. Mutual funds, by contrast, can trigger capital gains distributions even if you didn't sell anything, because of trading the manager does inside the fund. The cost: ETFs, especially index tracking ones, tend to have very low expense ratios, often comparable to or even lower than index mutual funds. There are also actively managed ETFs now, which charge more, similar to active mutual funds. The overlap: this is the part that confuses people most. You can have an index fund that's structured as an ETF, like a popular S&P 500 ETF, and that's different from an index fund structured as a mutual fund. Same strategy, different wrapper. The wrapper changes how you trade it and how it's taxed, not necessarily what's inside it. Who it's for: ETFs have become the default choice for most retail investors, financial advisors, and increasingly, even institutions, combining low costs, flexibility, and tax efficiency in one package. Now for the one that gets the most mystique: hedge funds. What it is: a hedge fund is a pooled investment vehicle, same basic idea, but with far fewer restrictions on what it can do. Hedge funds can use leverage, short stocks, trade derivatives, bet on companies failing, invest in private deals, or pursue highly concentrated strategies that mutual funds and ETFs are legally restricted from doing. Who can invest? This is the key distinguishing feature. Hedge funds are generally only open to accredited investors, in the U.S. That typically means individuals with a net worth over $1 million excluding their home, or income over $200,000 a year, $300,000 for couples, or institutions like pension funds and endowments. This isn't arbitrary. The reasoning behind these restrictions is that hedge fund strategies are considered higher risk and less regulated, so access is limited to investors presumed to have the financial cushion and sophistication to absorb losses. The fee structure: hedge funds are famous for what's called 2 and 20, a 2% annual management fee, plus 20% of any profits the fund generates. Some have moved to lower fees in recent years due to competitive pressure, but the structure remains a defining feature. Compare that to an index fund's 0.03% expense ratio, and you start to understand why the bar for hedge fund outperformance has to be enormous just to justify the cost. How you buy it: you don't buy hedge fund shares on an exchange or through a typical brokerage app. You typically have to be invited or apply, sign agreements, and your money is often locked up for months or years. This is called a lock-up period, designed to stop investors from pulling out money the moment markets get rough. Performance reality: hedge funds vary enormously by strategy and manager. Some genuinely deliver unique returns, especially in niche strategies like macro trading or merger arbitrage. But as an asset class, multiple long-term studies, including the HFRI index data tracked against the S&P 500 over the past 10+ years, show that hedge funds, on average, have struggled to outperform a simple low-cost index fund after fees. The famous Buffett bet mentioned earlier was specifically a bet against a basket of hedge funds, and the index fund won by a wide margin over 10 years. Who it's for: hedge funds exist for investors who want access to strategies unavailable elsewhere, short selling, complex derivatives, illiquid private deals, and who can tolerate higher fees, lower transparency, and locked-up capital in pursuit of returns uncorrelated with the stock market. For the average person building retirement savings, they're rarely the right tool, even if they were accessible.